Welcome back to the Deep Dive. Today, we are putting on our Talk Tickers hats because we have a stack of documents on the table that effectively signals the end of an era for one of the most reliable stocks in history.
It does.
It is January 28th, 2026. I'm your host, and I'm here to figure out why my screen was flashing red all day yesterday. To help me make sense of the carnage, I'm joined by our resident expert.
It's good to be here, though I have to say, if you're holding healthcare stocks in your portfolio, it's likely a very bad morning.
You know, usually when we look at earnings, we're talking about a beat or a miss. Maybe the stock moves 2-3%. But yesterday, I glanced at the ticker for UnitedHealth Group, UNH, and I thought my data feed was broken. I saw a double-digit drop. What on earth happened?
Your feed wasn't broken. The thesis was UnitedHealth Group closed down nearly 20% yesterday. For a stock that is usually as steady as a government bond, that is a violent move.
20%.
It closed around $282.70.
For a company of this size, that wipes out, what, tens of billions in market cap in a single trading session?
Hundreds of billions. And the volume was the tell. We saw about 65 million shares change hands.
Wow.
That's 6 or 7 times the normal daily volume. When you see a blue chip bellwether shed a fifth of its value on that kind of volume, it's not just an algorithm having a bad day.
No.
That's institutional capitulation. That's the big money fund saying, we're out, the story has changed.
Okay, so let's get into the why. Because on the surface, I saw a headline that said they actually beat their adjusted earnings estimates by a penny.
They did.
Adjusted EPS came in at 211 versus a 210 estimate. Usually a beat is good news. Why did the market just, well, ignore that?
Because in this specific case, that penny was meaningless compared to the structural damage in the report. If you peel back the adjusted numbers and look at the actual GAAP earnings, the real money they made according to accounting rules, it was shocking.
Okay.
Do you know what their GAAP earnings per share was for the fourth quarter?
I'm guessing it wasn't $2.11.
It was 1 cent.
Wait, 1 cent? $0.01 for the entire quarter.
1 single penny per share. Now, obviously, there are reasons for that. They took massive charges in the quarter, a cleanup, if you will.
Right.
They took a $1.66 billion net of tax charge. That wiped out about $1.78 per share of profit right there.
Okay, cleanup sounds like corporate speak for we made some mistakes and we're burying them all at once. What exactly are they cleaning up?
It's a mix. About $2.5 billion went to restructuring costs and exiting contracts that weren't making money. And then there's another $800 million specifically to true up the costs from the Change Healthcare cyberattack.
Oh, right, the cyberattack. That feels like ages ago, but clearly the bill is still coming due.
It is. But here's the thing. Investors can usually forgive a one-time kitchen sink quarter where you dump all the bad news.
Sure.
What they couldn't forgive and what caused that 20% crash was the guidance for 2026. This is where the floor really fell out.
I saw the revenue number, and honestly, it looked like a typo. They finished 2025 with about $447 billion in revenue.
Right.
But for 2026, they're guiding to less.
Approximately $440 billion.
So year over year, revenue decline. For UnitedHealth, I thought the whole point of this company was that it's a compounder. It just gets bigger forever.
Exactly. That is the regime change I mentioned. They are explicitly telling us the top line is going to shrink, but, and here's the paradox, they are promising that earnings per share will actually grow to over $17.75.
Hold on. Shrinking revenue, but growing earnings. That math doesn't track for me immediately. Unless they're firing everyone or selling the furniture, how do you raise your profit when you're bringing in less money?
Right.
That sounds like financial engineering, not growth.
It's a strategy they're calling strengthening, but you could call it shrink to grow. The market is skeptical because it implies they can cut costs faster than they lose revenue. And to understand why the revenue is shrinking, you have to look at the membership numbers. They aren't just losing customers by accident. They are actively showing them the door.
I want to dig into that because the numbers here are staggering. I saw the report mention a reduction of millions of numbers.
It is a massive exodus. Let's break it down. In Medicare Advantage, which has been the golden goose for the last decade, they expect to lose between 1.3 and 1.4 million members in 2026.
Over 1 million seniors leaving. Why?
Because UnitedHealth raised prices. They realized they weren't making money on those members, so they priced the plans to recover margins.
Okay.
They knew people would leave, but they admit The shopping behavior, seniors switching to cheaper plans, was much more intense than they predicted.
But it's not just seniors, right? I mean, they're losing people across the board.
Correct. Look at the commercial side. They're projecting a contraction of 2.3 to 2.8 million members total. A huge chunk of that is because they are effectively pulling back from the ACA exchange market.
Let's pause on that number 2.8 million people. That is roughly the population of Chicago.
It is.
When a company voluntarily fires the population of Chicago from its customer base, how do they logistically manage that? And what happens to those people? This isn't just a spreadsheet error. This is a massive disruption.
It is. And it signals that the era of growth at all costs is dead. Management, led by CEO Stephen Hemsley, is saying, we only want the members we can serve profitably.
Right.
If you're a high-cost patient or you're on a plan where the math doesn't work, UNH is essentially saying, we don't want your business.
There was another term in the notes regarding Medicaid losses that I keep hearing, redeterminations. They expect to lose over 500,000 Medicaid members, partly due to this.
Right.
Can we strip the jargon? What exactly does that mean?
Sure. So during the COVID emergency, states were told they couldn't kick people off Medicaid even if their income went up.
Got it.
Once the emergency ended, states started the process of checking everyone's eligibility again. That's redetermination. They are determining if you're actually poor enough to qualify.
And many aren't.
Exactly. Millions of people are being purged from the rolls because they make too much money now or simply because they didn't fill out the paperwork. For UNH, that's hundreds of thousands of customers vanishing.
Okay, so the customer base is shrinking. But surely shedding unprofitable customers is a good thing. Isn't this just smart business discipline? Why is the market punishing them for focusing on profit?
Because of the other side of the ledger, the cost of care. This brings us to the medical care ratio, or MCR.
MCR.
This is basically the percentage of every premium dollar that gets spent on actual medical bills. In 2025, that number ended at 88.9%.
Is that high?
It is incredibly high compared to history. The year before, it was 85.5%. That difference is billions of dollars in lost profit.
Wow.
And for 2026, despite shedding all those unprofitable members, they're guiding for it to stay sticky at around 88.8%. They aren't expecting it to improve much.
So they're firing the bad customers, but their margins still aren't getting better.
Utilization. People are going to the doctor more. Tim Knoll, the CEO of Medicare and Retirement, dropped a specific number that spooked everyone.
Oh.
He said medical trend, which is inflation plus usage, was running at 7.5% in 2025. For 2026, they expect it to jump to 10%.
A 10% jump, so that means more knee replacements, more heart surgeries, longer hospital stays.
Exactly. Physician fee schedules are up, service intensity is up. So UnitedHealth is caught in a trap.
No.
The cost to provide care is skyrocketing, so they raise prices. When they raise prices, the healthy customers leave, leaving them with a smaller, sicker pool of patients.
Which keeps the costs high. It's a death spiral.
Adverse selection is the technical term, but death spiral works too.
Let's pivot to the other side of the house. Optum. Usually when the insurance side struggles, Optum, their services and tech arm, saves the day.
Right.
But it looked like Optum hit a wall too.
Optum Health margins disappointed significantly. So management is doing what they always do, a reorg, and this one is risky.
A reorg.
They are moving Optum Financial under Optum Insight.
Translate that for me. Optum Insight is the data guys, right? And Financial handles the payments.
Right. Optum Insight is the tech, the analytics, the data processing. Optum Financial is the bank. By merging them, Patrick Conway, the Optum CEO, says they want to move from post-service reconciliation to real-time point-of-care approval.
That sounds like the holy grail healthcare has been promising for 20 years. You swipe a card at the doctor, and it clears instantly like buying groceries, rather than getting a bill 6 months later.
That's the dream. But let's look at the execution risk. Merging a banking operation with an IT department is easier said than done.
I can imagine.
Historically, healthcare tech integrations are where capital goes to die. They're throwing $1.5 billion at this in 2026, specifically on AI and modern tech.
$1.5 billion is a lot of money to spend on AI. Is there skepticism that this is just buzzword spending? Or is it real efficiency?
The market is definitely skeptical. They claim 80% of member calls are already leveraging AI. But if you've called an insurance company lately, you know it's not exactly a seamless experience.
No, it is not.
The fear is that they're spending billions on tech to fix a margin problem that is actually caused by humans just getting sicker.
And speaking of problems they can't fix with AI, we have to talk about the government. because it felt like there was a third player in this earnings call, and they weren't friendly.
The macro hammer. The CMS advance notice for 2027 rates.
Right.
This is the government deciding how much they will pay these insurers for managing Medicare plans.
Yeah, the number was effectively 0, right?
A proposed effective rate increase of 0.09%.
0.09%. With inflation running at 2 or 3% and medical costs rising 10%, that's a massive cut in real terms.
It's a gut punch. And here's where we need to explain coding intensity. The government believes that insurers like UNH have been gaming the system.
Making patients look sicker on paper.
Exactly. Sicker on paper than they actually are to get higher payments. So the government is changing the formulas to clamp down on that.
So the government is saying, we know your game and we're closing the loophole.
Precisely. Management called the rate insufficient and disappointing. They even made a direct political comment about funding pressure from the previous administration, which tells you the environment in Washington has turned hostile.
Yeah.
It doesn't matter who is in charge. MCOs, managed care organizations, are an easy target.
So let's look at the perfect storm here before we get to what to do about it. You have customers leaving in droves. The population of Chicago, gone.
Gone.
You have the people who stay getting sicker and using 10% more care. And you have the government effectively cutting your pay.
That sums it up. That is why the stock is down 20%. The narrative has shifted from UnitedHealth is a compounder to UnitedHealth is a repair job.
Then investors hate repair jobs.
Absolutely. It shows in the analyst reactions, too. Piper Sandler cut their target. The market is pricing in structural margin risk.
And look at the divergence. Over the last year, the S&P 500 is up 17%.
And UNH is down 46.
46%. If you own this stock thinking it was a safe haven, you have missed out on one of the greatest bull runs in history while losing half your money. That is painful.
Incredibly painful.
Okay, that is a bleak picture. But we are talk tickers. We don't just admire the wreckage, we try to figure out if there's any scrap metal worth selling. It's time for our favorite segment.
The disclaimer.
You know the drill. This is not financial advice. We are two voices in your headphones, not your fiduciary. Do your own diligence.
Please.
But if you were sitting on a trading desk right now looking at this mess, what is the outrageous but plausible trade?
All right. The managed care sector is in the penalty box. But we have to look at the physics of the money. We established that utilization is jumping to 10%.
Right. People are getting surgery.
Just so everyone follows the money here, every dollar UnitedHealth loses on unexpected medical costs is a dollar that ends up in a hospital's cash register.
It's a zero-sum game.
It is. If the insurer pays more, the provider earns more.
So the tray is the utilization arb.
Exactly. You go long, a basket of high acuity hospital chains and surgery centers. The company is actually performing the knee replacements and heart surgeries. They're going to see a volume boom.
And you short the bears.
And you pair that by going short the insurers, UNH, or the sector ETF. So you're betting on the transfer of wealth. You don't care if the sector goes up or down. You just care that the hospitals beat the insurers.
I like it. It hedges the market risk.
Correct. But if you want the outrageous kicker,
I always want the kicker.
you look at the policy panic straddle. The final CMS rates, that 0.09% number, get finalized in April. Right now, the market thinks maybe the government will cave and raise it a bit.
And if they don't?
If the government holds the line at 0.09%, it will force a liquidity event across the whole sector. We saw UNH drop 20%. Imagine if Humana, CVS, and Cigna all do that on the same day in April. So the trade is buying deep. Out of the money, it puts on the XLV, the big healthcare ETF, expiring in April.
So you're betting the government isn't bluffing.
You're betting on a sector-wide crash caused by a bureaucratic memo. It's not a trade for the faint of heart. But look at yesterday. The safe trade lost 20%. Maybe the risky trade is the only one that makes sense right now.
So to wrap this up, 2025 was a mess. 2026 is a shrink year. The government is squeezing from the top and patients are squeezing from the bottom.
The days of set it and forget it for healthcare stocks are over. This is now a battleground of execution versus regulation.
The question for you listening is, do you believe the reset story? Is this the bottom where a great company slims down to fight another day? Or is the golden age of Medicare Advantage officially dead?
That is the multi-billion-dollar question.
Eat your stops tight and your utilization low. We'll see you in the next print.